What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is January 26th of 2022. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we've got to talk about why here today, on January 26th of 2022, we may be entering not only into one of the most important days in this year for cryptocurrencies, but probably one of the most important and decisive days for crypto markets in history. I don't want to be melodramatic, but to be honest, guys, there's a very big event going on today that is probably going to be the spearhead that leads us towards either rallying up to that 150K, 200K range that we've been talking about in the past, or is going to drag us down into what might be potentially a bear market, not just for crypto, but for all assets alike. Now, let's go ahead and we'll dive into the conversation here, guys. It's a very informative video, and if you happen to like it, consider subscribing, liking, and hitting that bell icon. It'll make sure that you guys get notified for each upload we put here on the channel. You can always unclick it later on and stuff if you guys don't want to get notified for every video, but I digress. Let's go ahead and kick things off. So, as you all know, we talked about this idea of Bitcoin about a month and a half to almost 2 months ago, of Bitcoin coming back down towards this range in the $30,000, $35,000 price band. And we've gotten that. We came down here towards $33,000. We finally have started to see some positivity in the market over the past couple days. For the past 4 days here, market price has remained in the green, and we've started to move up from around $33,000 at the lows towards $37,700, right? So pretty stellar rebound here, starting to make up for some of the losses. And a lot of people are immediately thinking, Nick, this is an absolute guaranteed rally. I've got to go in, I got to start buying right in the market. Just like how I should have shorted the market when it was going down, guys. I'll say the big thing here is this, to not rush into anything. And a big part of this video, we'll be talking about that, right? Now, I do want to emphasize here, I want to make something very clear. This is the favorable range here where, look, if you've got some additional fiat on hand, averaging into the market may not be a bad deal, right? If you've got money in this case where you've got a long-term time preference, this is the discount range you usually want to go into the market. And we can see across the board here that that's the case. Ethereum down 55.77%, similar to the range we saw back here in May for the correction. Solana again, right? No matter how you feel about these protocols, guys, I gotta say, I'm liking Solana a lot more at a 68% discount at, around the range it's at now, around this $80 to $90 range, than buying it up at $253 per token. Outside of that as well, you've also got Avalanche here as well, right? Another major layer 1 protocol down from nearly 150 bucks down towards $50, right? A near 2/3 correction in value, right? Buying it at a near 66% discount, right? I want to make it very clear, this is the kind of range where you do start to turn bullish. And all the while, in this case, you can start looking at some of these positions for discounts. I do want to drill a very important point here, which is that there is a macro event here today. I'm just going to cut to the chase here. It's the Federal Reserve FOMC meeting that is going to determine whether or not these corrections are a buy-side opportunity or if they are just the beginning, and that things might get much worse than where they are right now. Right? And that's again why I emphasize to stay away from leverage trading, stay away from the speculation. But instead, if you are looking to again build positions in some of these plays on a discount, and you got that long-term time preference, plus you don't like dealing with the hassle of taxes in the short term, you guys can always check out today's sponsor, which is iTrust Capital. Right? They're one of our partners here on the channel. We're big fans of iTrust Capital, and they just recently enlisted Avalanche, or AVAX, towards their token list. So you can now invest and also trade in and out of owning coins like Avalanche through a cryptocurrency IRA. Again, they've been one of our partners here on the channel. Really good platform, just had a major raise. So they're continuing to expand their operations. Great support. So if you guys want to check them out, feel free to check the link down below in the description. But Avalanche is one of the many really cool protocols here that I would say I'm keeping an eye on here as we go through the discount. It's one of my favorite alternatives outside of Ethereum, but I digress on it. The major point here is this, that the market is finally at a good discount range here. We've got some great buy side potential. And outside of that as well, the data science models are starting to signal this, right? We've got, for example, our exclusive indicator data science aggregate model that we share within the Dash report, right? Right here, this is the Bitcoin Flow Index. And we can see here that the Bitcoin Flow Index has been in the same kind of chopping range that it usually is within any given bull market, right? Market's at a really incredible discount. There's a lot of fear going on right now. You've got the HODL waves as well, reaching a new high here, even above where they were back here in 2015, right? We can see here that if we take a look at the bands here, what we're highlighting here are the HODL wave bands that go over 6 months or more, and we've just reached a new peak there for the HODL waves. To put it in a more simpler way, the 1-year HODL wave has been spiking up here since the fall and winter of 2021 going into the new year. And that's a sign again of contraction of liquid supply in the market. It means that people are buying up Bitcoin and they're holding it more long term, right? It's not meaning that it's an absolute foolproof model, but what it guarantees to some degree is that compared to a few months ago, we have less people moving crypto onto exchanges or off exchanges, and more likely are simply holding it in wallets. And we've seen, there's been all these tweets from Twitter that I've seen as a recent where people are tracking the on-chain analytics, how some addresses are just stacking up Bitcoin during this discount. They're buying up dozens and dozens of Bitcoin during these sell-side events. We can see that the logarithmic growth curve showcases we're at a 0.15 on the score here. The only other times we were down here was during the corrective phase when we were already at a price range of 6,000 to 7,000 here for Bitcoin. Back here during the peak fear of the bear market, right around a price range of around 3,500, and also back here during the accumulation period, the bottom of the bear market. And we can see here as well, back here in 2011, right? We can see that whether it's a mid-cycle correction or the bottom of a bear market, this, when it comes to the logarithmic growth curves, is a good time to start looking at Bitcoin and crypto assets. But all of this, at the end of the day, all the while it holds some relevancy, I gotta be honest with you guys, and as much as we love data science, at the end of the day, the thing that matters is what the Federal Reserve is going to do. Here today, on January 26th, the Federal Reserve will hold yet again another FOMC meeting, right? This is the Federal Open Markets Committee meeting where they're going to be sitting down and deciding whether or not they want to engage in what they've been talking about for the past couple of months, which is quantitative tightening, right? Inflation is supposedly in this case, I think it's always been a problem, but now it's gotten really much more relevant, I think very clear to the economy. Inflation is a key priority of the Federal Reserve, or in this case, they're stating to tamper or to take down inflation, right? We've seen the Federal Reserve's CPI index in this case going towards around 7% annual inflation. And I think we know that it's probably a little bit more than that. But I digress on it. Because of this and the pressure from the Biden administration and also the Federal Reserve to taper, kind of cool down this inflation, they're looking to taper monetary policy. They're looking to engage in quantitative tightening, meaning that they're going to start to probably reduce their bond buying programs, which have helped to stimulate capital into the asset markets. They're going to start to look towards raising interest rates, which is going to increase the base cost of new capital or credit in the economy. It's going to make interest rates on savings accounts go up, but at the same time, the loans, the mortgages that you take out, the auto loans are probably going to get more expensive. And also, the funny money into the asset market is going to get more expensive, and people probably aren't going to take as much risk as they would have before when interest rates were near rock bottom. You can borrow money for practically free. Why not go borrow it and go buy finite assets? That's basically what's been happening for the past more than the last decade, right? So what we need to understand here is that this meeting here today on the 26th is going to shape the direction of asset markets. The Fed has been walking with a big stick, stating that it's going to really start to hamper down on monetary policy. It is going to turn hawkish. It is going to increase interest rates. It is going to, in this case, lower the quantitative easing in the economy. This has been the major focus point here from the Federal Reserve. And this chart here showcases the current projections. This is the survey that is going around here on what the Federal Reserve might do in the sense of increasing interest rates here over the near term. And you can see here that we've got a roadmap here rising up towards 2% all the way into 2024, the close of the year going into 2025. Right? Now this alone is already spooked markets, right? And I gotta be completely honest with you guys, the reason it spooks markets is because the market has gotten so used to just having free credit, right? 0% interest capital allows asset markets to prolong and grow. It's what's allowed crypto to be able to become as big as it is as an asset class in a short period of time as it has. It's allowed equity markets to go through the longest bull market in history. And even if you include the pullback we had back in March of 2020, the swift recovery we had afterwards, it almost seemed like a bump on the map, and we continued to new all-time highs, right? It has led to the longest everything bubble in history, right? Now, the question here remains, if the Federal Reserve does actually stick to its word, if it actually goes about hiking interest rates this go around and showcases that, whether in this meeting and the next few meetings, that it's not kidding around, it doesn't matter what asset markets think or how they react, that they're going to continue through this, it will cause further sell-side pressure in Bitcoin, and it will cause further sell-side pressure, not just in Bitcoin, but in equity markets, which have already taken a hit here, right? We can already see that the NASDAQ, for example, right, which has been, again, leading the market for a long period of time, starting to come down here from 16,000 down towards 13,500. Got the S&P 500, another major stock market index, down from 4,800 down here to 4,300, right? Dropping all the way down to 4,200 just the other day. There's also 2,000 small cap index, smaller companies, right? Thousands of 2,000 small cap companies coming down from a market index value of 2,450 down here towards around 1,900 the other day, right? The market is starting to really pull back on gains. Practically all of the gains that were made here in 2021, at least for the Russell, and starting to cut back a half a year's worth of gains here for the S&P 500 and the NASDAQ. Scary stuff here, right? Because the market doesn't like it. The asset market needs that cheap credit in this case. The credit that should have been going into the real world economy, but unfortunately has been going into propping up asset markets and 401ks and retirement accounts. That's what's been going on for the past couple years. And all the while, it's been a very easy game here of when we get discounts like this, right? Whether it's in stocks or in crypto, to just buy the dip. As much as I love crypto, I'm going to be fair with you all in saying that if the Fed decides to really stick to its word and go heavy on interest rate increases, that is going to be a warning sign, right? Now, if the Federal Reserve, and I want to make this last point clear here, especially for those of you who have listened to me ramble on long enough, if the Federal Reserve does increase interest rates, I think that's something that most people are expecting today, right? I'm in the camp still of like, I'll see it, I'll believe it when I see it, right? The Federal Reserve actually does increase interest rates. But they do, on the other hand, state that they're probably going to engage in further rate hikes at a slower rate, or, for example, maybe they won't, cut back on their bond buying program as much as they previously stated. If they ease in some nice statements like that, that will already be the first sign the Federal Reserve is just trying to do the bare minimum, right? And if we do get some positive sentiment like that, then asset prices could start to rebound. We can live in an environment where interest rates are 0.25%. That's fine. But to be fair, if interest rates really start to get to 1 or 2%, that's the reason asset markets are panicking. Because unless there's some debt restructuring in the economy, the amount of debt that is built up as a percentage of GDP has gotten to heightened levels. And it's only going to get worse as that interest rate goes up, right? So this is, again, why, at the end of the day, we need to follow Fed monetary policy. It is going to drive the direction. Like I said it before, just like how the Fed was the reason for buying the dip every single time people panicked in the market. It's like, no, just buy the discount. And, of course, asset prices would go up. It also plays out the opposite way. Federal Reserve stops easing monetary policy, right? If it stops providing easy stimulus in the economy, right? And if the federal government stops the kind of stimulus programs they had during the pandemic, well, asset markets are going to do the opposite. People are going to recede back to cash. They're going to have more money in a savings account. And I'm not even here saying that that's an entirely bad thing, right? A saver's economy is usually beneficial towards the everyday person, right? And I think that that's wonderful, right? But at the same time, all right, I'm here to tell you guys about what my strategy is with crypto assets, with my investment strategy. If the Federal Reserve is signaling that for the next 5 years, they're not going to be doing much stimulus at all, I really don't have as much incentive to go into assets as I usually would, right? If they're really going to start cutting back. But I got to be honest with you, I just don't see it. The Federal Reserve has said one thing and done another for the past decade. That's not just me being opinionated or negative against the Fed. That's just the reality of it. They own assets. Everyone owns assets. they don't want to spill over the punch bowl, so to speak. They don't want to end the party, right? And I think that that's again what we're going to see here in this FOMC meeting. A lot of people are walking into it fearful, as per usual. The Federal Reserve is going to find some nice middle ground to say that they're doing something, but in reality, not really do much. It's just like when they said that inflation was transitory, that it was a mere passing, right? And to be honest, we know it's not. We know that inflation is bad, and we know that the Fed is probably not going to do anything significant until inflation rates reach double-digit territory, like they did during the early days when Paul Volcker was in the Fed. And then he really pulled the switch. He increased interest rates dramatically, surging the cost of new credit and capital in the economy, and that led us into a recession. But a recession that was relatively short-lived, kind of reset the economy. It did curb inflation, and we were able to get back on track, right? But in this period of time, the Fed can really only do that if we go through a massive phase, and this is something people don't talk about, a massive phase, and I think Ray Dalio has been one of the only people talking about it, of debt, I'll make sure I quote it properly. I just got it now. Debt restructuring, right? Restructuring all the debts of the global economy, sitting down and actually starting to curb the huge debt pile that the world has built up. There will always be more debt than there is money in the system. That's a known given fact, right? And it's going to expand as a part of GDP over time. But it's going to become a growing burden here for the taxpayer and for the global economy if we don't go through this phase of restructuring and if we hijack rates. So that's in a sense a major global reset that needs to happen if the Fed were to try to hike interest rates. And that's why they're in a bit of a pickle here until they actually go through that. And how that looks and how it's going to work, no one really knows. But I digress, guys. I've rambled on long enough here. We know what to look for here. The too long did not read version. Wait to see what the Federal Reserve does here today. If you want to build positions, that's fine, but make sure you have stops set if things really start to turn south. I think that's the best means to protect yourself right now. And always have some cash on hand. Don't be all in on anything, right? Anyways, that's it for today's video, guys. You've heard me ramble on enough. If you like this video, drop a like. Consider sharing it with a family or friend member who might be interested in the topic. And if you haven't already, subscribe and smash that bell icon. Thank you guys so much, as always, for tuning in. I always appreciate you giving some time out of your day to listen to me. And I hope it's provided value to you all. And I'll see you all in the next video. Take care, everyone.